Hey guys, so I sat down with a good friend and previous client of mine this morning, and she mentioned that the most confusing questions she had when starting into the buying process had to do with choosing a loan type and knowing what was even being talked about when discussing those loan types with lenders and just trying to make that decision. So I'm going to devote the next few blogs to breaking down loan types and just kind of giving a brief overview. I mean, obviously talk to your lender. They can answer questions a lot better than I can. I'm not, that's not my area of expertise. So I'm not an expert in it, but I'm just going to break down kind of, I guess, the big terms that you'll be hearing. So, if you hear a conventional loan, because I've talked to a couple people, and actually I was one of them before I actually learned what a conventional loan was and what other loan types were available. And anytime loans, I cannot talk today. Please excuse me. I did not sleep last night, so I'm slurring everything. Anytime loans got brought up, I would just automatically be like, conventional. Conventional. 30-year conventional. Just because it's the only thing I had ever heard of up until real estate. So a lot of people know about conventional loans. A lot of people know that the common length is 30 years. It's just kind of the default length of 30 years. But that's the one I'm going to be talking about today, and then I'll break down the rest of them in future vlogs every Tuesday and Thursday. So basically, the overview of a conventional loan is, it is a really popular one. A lot of people know about it. And it's just kind of maintained this safe reputation because it's not government insured and it's not government funded. So you're getting these private lenders. And so you didn't really see its reputation crash with the '08 crash. It kind of came out of it still being considered one of the safer, more trusted loans. Not saying that the others can't be trusted or that they're not good loans. That's just the reputation that follows the conventional loan. So it's not coming from the government. So I guess you can know that when you sit down with a lender, you can know that what the loan you're talking about, it's not government funded, it's not government insured. A couple other things you'll want to know is LTV is loan to value. So if they mention, a 95% LTV, that means that you are taking out a 95% loan, and that is 95% of the total value or purchase price of the home. So if you're coming in with 5% down, then you'll be looking at a 95% LTV. If your LTV is above 80%, your lender will ask that you have it privately insured, just because that is a little bit higher risk. You're coming in with not as much down, and it's not a big deal, and I think it's awesome that you can come in with a greater LTV than 80%. So don't shy away from it. Just know that, if you do have a greater LTV than 80%, then you will be asked to privately insure that. So definitely know that term. Know that that's what they're talking about. Nothing too scary. It's pretty simple. The term, that's going to be your 30-year. If you want to make higher payments and have it paid off faster, if you can afford to pay more each month, you can knock that down to a 20-year, a 15-year, whatever works for you. You don't have to go to that 30-year. If you need to have smaller payments, then you may want to look at more of a 40-year or 45-year. Or whatever is available through your lender. So definitely try and work out, what the numbers would be depending on how many years you have that loan. So that's going to be the term of the loan. So definitely know that as well. Trying to make sure I stay on topic here. There are two different types of conventional loans. There's a conforming loan and there's a jumbo loan. So conforming loans are less than $417,000, jumbo or anything over that. So not a purchase price of $417,000, but the actual loan itself. If you go into the jumbo loan, you're going to see higher interest rates. So keep that in mind, that you will definitely see a difference there. But, talk with your lender more about that if you are going to be taking out more than $417,000. But for the most part, I have only dealt with the conventional conforming, because you don't really see, at least not with the buyers I have been working with, are all kind of more of the $200,000, $300,000, maybe low $400,000 price ranges. So I haven't seen a lot of jumbo conventional loans, but I'm sure they do happen here in Boise, since we have some really upscale homes with some big upscale price tags. But anyway, so that's the difference between the conforming and jumbo, and that is the cutoff. It's right at the 417,000. And then basically the last thing, and this may not seem like that much information about loans, but they're actually pretty simple. I mean, it's not as scary as I think a lot of people believe it to be, as long as you know what you're looking for. But the last thing is just going to be your interest rate. There are fixed rate loans, or fixed rate interest rate loans, and then there are adjustable rate interest rate loans. So the difference between those is kind of the fixed rate, pretty self-explanatory, as well as the adjustable, but you're going to see your interest rate will be locked in and it will not change on you until you have paid that loan off. So personally, if I were to get a loan, I would go with the fixed rate, just because I like an A to Z plan. I like knowing, if I pay $9.85 each month, it will be paid off in 30 years. And I don't like having any question marks or anything like that. So personally, I like the fixed rate just because it's safe. I know what to expect, and it's consistent, and I like those things. So if you're a little bit more daring, live on the edge, then you may want to look into the adjustable rate loans. It's basically, you'll start out with a lower interest rate than what you would start out with a fixed rate loan. So you're going to start out with a lower rate, and then after 6 or 12 months or however long it is specified in the loan to be, you will see that interest rate excuse me, you'll see that interest rate start to adjust, and it may adjust monthly, every 6 months, every year, whatever your lender specifies. So be sure to ask. Basically, the benefit of going with an adjustable rate is if you know you're in kind of a tighter place right now financially, but you know that you'll also have a spike in income down the road, then maybe it would be better to start out with a lower interest rate now, and then have that change up down the road when you'll have that spike in income. So that's basically it as far as conventional loans. Nothing, like I said, nothing too intimidating. It's nothing too confusing. At least, hopefully, I kept it fairly simple. And that way you'll kind of know what to ask for when you sit down with a lender and start to talk with them about conventional loans. Is what is my LTV? And you can calculate that yourself, of course, if you know what you're going to come in with down. But definitely figure out the LTV and then the cost of getting it privately insured, if it's going to be greater than the 80%. Figure out your term and what your monthly payments are going to be depending on how long that term is, and then adjust your term accordingly. And then, of course, decide if you want the fixed rate or the adjustable rate. And those are kind of your big points. And then the rest is just filling in the small details with your lender. So hopefully this has helped break conventionals down, and I will be back to break down the rest of them next Tuesday.